This is Retirement Roadmap Radio with Mark Fricks from Master Plan Retirement Consultants. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is Retirement Roadmap Radio with your host, Mark Fricks.
Hello again, and welcome to another episode of Retirement Roadmap Radio with me, Mark Fricks, your host. And today I'm flying solo, so forgive me for any mistakes I might make because my excellent co-host is taking a week off and will not be joining us today. As you know, Tony Shore is my co-host and does an excellent job, but he's not with us today. But we'll be just fine. We'll survive this and be better people for it. How about that? But a great show today. We're going to be talking about something that's very apropos for today's environment. And the title is What Monsters Are Lurking in Your Portfolio. Okay, so with the volatility going on, with the election mostly over, with a lot of promises coming from the new administration about taxes and social spending and things of that nature, it's certainly going to cause the stock market to be that much more volatile. So we're going to talk about that today, and I think this would be very applicable for most people's situation here, especially if you're preparing for retirement. If you're within 5 to 7 years of retirement, you really need to take a step up and begin managing your portfolio or having somebody help you with your portfolio from a standpoint of retirement as opposed to typical growth and things of that nature. So we're going to get started here and cover some of this here. So the first thing I want to talk about, basically, whatever happens in your portfolio over the coming weeks, months, and years could affect the rest of your life financially, right? So we want to treat this correctly. And the first thing I want to talk about is how many people have the wrong risk tolerance. In other words, you think you believe one way about the risk you're taking, when in fact that's not correct, okay? And it seems to come to roost the most when we have a plunge in the market. In other words, back in March when we had the bear market hit, we had a 20% drop in one of our indexes and 26% in another major index. That signals a bear market. When that happens and people see their accounts drop by 15 or 20 or 30 or whatever, they suddenly really realize maybe they weren't quite as risk tolerant as they thought they were. And so we want to know that beforehand, right? And so, most people that do any kind of investing, they'll give you a risk tolerance test, a questionnaire really is what it is. The problem is that typically doesn't happen with a 401k. And where does most of our money lie in America? It's in 401ks and 403bs and thrift savings plans and things like that, things that work, right? And so there's no risk, test, or very few, I've not seen very many, with your 401k. There's nowhere you can go in and take a test. And even if it is, it's going to be, very subjective, and I'll explain what I mean by that. What I mean by that is it's one thing just to answer 10 questions. It's another thing to take a look and have a discussion with somebody. So we give questionnaires and that, but I find out more about risk tolerance through discussions with our clients and through finding out how they feel about certain things and what their goals are and what their real dreams are and when they're going to retire and why it could or may not happen and things like that. So it's really interesting whenever I have somebody come in the office or I have a meeting online with someone and they share their statements with me where they're currently invested. I'll just ask them. I'll say, what kind of risk tolerance do you think you have? Are you moderate, aggressive? Maybe 1 out of 100. Would you put yourself? And most people will go probably 55 to 75 or whatever. And I say, okay, all right. So let me take a look at where you're at, and I'll look at their statements, and they are almost always much more aggressive on the way they are actually invested as opposed to what they say they are. And then when I start questioning and I start going through the risk questions and things like that, it basically tells me that they're even less aggressive than they thought. And so, when that downturn comes, it's going to hit you harder than you expect because you've just got the wrong allocations, right? The other thing we have to think about too is not just about how much in stocks, how much in bonds, how much in international, large cap, small cap, that type of thing. But as you start getting close to retirement, we also need to start protecting some money. You've heard me on this show before talk about the color of money. And there's three colors of money, and so one's cash, one's stock market, and one is protected money, which is money that has the principal insured by an insurance company, but still has growth. Okay, and so some of that needs to be set aside too, because again, there's some of that money you can't afford to lose. When you're retired and you're replacing that paycheck, if you're depending solely on the market to replace a paycheck, your income could fluctuate. And my power bill doesn't fluctuate much. I mean, it goes up more in the winter and maybe less in the summer, but my house payment doesn't fluctuate, right? My car payment stays pretty much the same, right? And so we need this constant income coming in. And so it's taken it even a step further than just risk tolerance and having the wrong one, but also more diversified, not just from stocks and bonds, but to different kinds of holdings. And that kind of leads me into the second part of today's show, and that is most people don't have any risk protection tools. So, well, Mark, what's a risk protection tool? Well, it's what I just mentioned. It's a way to reduce risk. A lot of what my job is as a retirement consultant is not only looking at, growing money and producing income and doing estate planning and tax planning, but understanding what risks lie ahead in retirement and how do we handle those risks. And so one of the biggest risks in retirement is, again, having a large drop in our money, which causes a drop in our income. And so part of our money needs to be risk protected. And right now, the most popular tool and the most effective tool to do that is a very particular type of annuity. I'm not going to get into all the specifics, but it is an annuity that protects the principal, has no fees or very small fees, unlike a variable annuity. Okay, this is a fixed index annuity, and it's not in the market, but it follows the market up, but it doesn't follow the market down, okay? And so here you've got something that's been averaging long-term 4 to 8%. Got one or two that are doing a little bit better right now, but I like to keep it kind of conservative. So 4 to 8% growth. Can't lose your principal. And it also offers an income tool that allows you to get a guaranteed income for the rest of your life once you get to that point that you need it. So that's kind of part two of today's show is, most people, when they start looking at their portfolio, they don't have any money risk protected. The old days when my granddaddy was around, CDs were kind of the risk protection tool, right? Guaranteed your principal, had a little bit of liquidity issue, but not much. But you could get, 4, 5, 6, 7%, right? That's gone, and it's going to be gone for a lot longer as well. I mean, the Fed, they're going to be keeping rates low, and even if they let them rise to 2 or 3%, you're still looking at a CD paying 3. Okay, that doesn't keep up with inflation, folks. All right, so these annuities are doing a good job of kind of replacing the old CD mentality, and we even stack them like CDs. Some of you guys may have done this before, where you have maybe a 6-month CD and a 1-year CD and a 2-year CD and a 3-year, so forth and so on. So they're maturing at different times, right? And that's a good idea. But, we do the same thing with these index annuities. We'll take somebody's 401k and maybe take a 30% of it and split it into 3 of these fixed index annuities. And one maybe we turn on the first year of retirement. One we turn on maybe in year 5 because of inflation, right? We need more income coming in, and then maybe the third one in year 10. And what's nice is they're flexible enough that we don't have to turn them on at that planned time. Maybe we end up in year 5 and we still don't need extra income. Well, we leave it alone for another year, so they're very flexible from that standpoint. So again, number 1, wrong risk tolerance, and number 2, no risk protection tools. Okay, so we're going to take a quick break here. I want to just give you a couple of little housekeeping items here. Number 1 is, folks always want to know how can they get a hold of us, and so what we've been doing during this time, during the COVID time, is offering one-on-one complimentary webinar type meetings or web meetings. Okay, very simple to use. Don't let it scare you. A lot of you are already doing that because of the COVID situation, but these are complimentary, and it's really just a time for you to talk about or ask me anything you want to ask me. You can, hopefully financially, right? I can't help you with that sore shoulder or anything like that, or maybe I can. You never know, right? But it's to answer those questions. What about Social Security? Will it be around? How should I be treating my 401k? Should I roll my 401k over to an IRA? Should I convert some of my money to a Roth? All these kind of questions that people have that we can help them answer. And sometimes we can answer them right then. Other times we have to run some reports for you to get a better idea of your situation, because I don't want to give you an answer when I don't really know enough about you. But again, this is all complimentary. Our average person that we schedule an appointment with will run 7 to 8, even 9 reports. Okay, so if this is something that is of interest to you, there's no obligation. I've got 5 openings for the next week. Just contact us. Say, hey, I want one of those complimentary consultations Mark mentioned. Put me on the list, and the first 5 that we get scheduled, we'll see them complimentary. Reports are complimentary, and I'll be glad to send you a copy of my book, complimentary as well. Okay, and really that's just to help folks, and we find out the little bit of cost it is to us, it's worth the people we can help, and sometimes these people we meet with become great clients. But if they don't, that's okay too. It needs to be a good fit, and we need to make sure you're a good fit for us as well. Okay, so how do you contact us? Great question. 770-980-9262 is the old-fashioned way. 770-980-9262. If you're driving or can't get to a pencil, 2 things that are easy to remember. Number 1 is our website, masterplanretire.com. masterplanretire.com, all one word. The third way that's kind of easy to remember is text to the number 21,000, the phrase master plan. Okay, and that will get you, let me double check, that's right, 21,000. Yeah, I just want to make sure. I never text myself, right? So the number is 21,000, and the phrase is master plan, one word, and within about 5 to 10 seconds, you will get a text back with all of our contact information, okay? And so that's 3 great ways to get a hold of us. And if you visit the website, if you just want to find out more about us, you can do that as well, masterplanretire.com. You can also actually, right on the front page of our website, push a button and go ahead and schedule that appointment right there. My calendar pops up, and you pick out the time and the date, and you will be on the calendar. We'll follow up with a confirmation along with an invite to the web meeting. We are doing some face-to-face meetings. We're located here in Marietta, Georgia, just outside of Atlanta. I'm not traveling as much as I was, so if you're outside of this area, or if you just don't want to do the face-to-face, be glad to do the Zoom or the web meeting. Very easy to do. So we're going to take a short break here, and we'll be right back, and I hope you stick around. Welcome back to the second part of today's show, Retirement Roadmap Radio, with me, your host, Mark Fricks. As I said earlier, I am flying solo today, so if your favorite co-host is Tony Shore, he's not with us today, but we're doing great without him. Not as good, but we're doing good. We're doing really, really good, but we're always better with Tony. So, but we'll be fine. We're covering some great information. We've actually been talking about what monsters are lurking in your portfolio. And so far, we've talked about having the wrong risk tolerance. And then we talked about not having risk protection tools. As we get closer to retirement, we need to start protecting some of our principal. And so we talked about how that looked, what that looked like, and things of that nature. So let's get into the third area here, another monster that may be lurking in your portfolio, and that is impulsive decisions. Okay, there's a company called Dalbar or Dalbar Research, and all they do is investor behavior research. Okay, and I want you to listen to this. This is pretty interesting. They went back, I don't know how many years, 20, 30 years, maybe 40 years, and they studied the average equity investor. In other words, the average person that invested themselves in the stock market. Their average return over that period of time has been less than 3%. Okay, so Mark, how could that happen? Well, what it is there's two emotions when it comes to investing your own money: fear and greed. Okay, so I'll give you an example. Back in March and April, when the COVID pandemic really started hitting, actually it was late February, the S&P 500 declined 33.93% in a month. Okay. Now, the S&P is the main barometer of our stock market. It's the best barometer, okay? And so what a lot of people did is they became fearful, and they started selling. Now, maybe they sold after it dropped 5%. If you remember, it dropped really, really quick. Maybe you did it at 15%. Maybe you did it at the bottom of the market, which is when most of the trades were made, right? And so here you've locked in a loss of 33.93%. Okay, and if you sold that and moved it to cash, you missed out on the bounce back, because since March 23rd, the market's up almost 50%. Okay, now you just lost 33% and missed out on making 50. All right, so that's a swing of like 80, I think, or something like that. If you had just stayed the course, you would have dropped back 30, but you would have eventually made 50. Okay, and so that's where that fear comes in. Now, the problem is it may not have happened that way, right? I mean, maybe you decided to sell out and the market didn't recover for 3 years, but you sold out when it was low. Maybe you sold out early, But the problem is the 6 largest gains of the average year. The top gains of any average year happen over 6 different days. In other words, there's only 6 times when you're going to have a great gain. Or the 6 biggest gains in a year. I'm probably getting that slightly incorrect. But if you're in and out of the market and you just miss half of those, you just missed half the gains for the year, right? And so instead of making 30% for the year, you might have only made 10 or 50, or maybe you lost money again because you got out. I know people still that haven't gone back into the market since 2008, 2009. They've missed out on tremendous growth since that time, okay? And so that's why many times as we get close to retirement, it's a smart idea to get someone to help you with that investing. Some of our best portfolio managers are up in the 20 and 30% range for 2020. And so because they didn't panic, they followed, the algorithms. They followed the computer readouts. They followed all of that, and they didn't have any emotions involved, right? And then, of course, the fear of greed. There's always this thing, hey, the market's up 30, it's always going to be up, or it's going to keep going up. And that's not true. What goes up must come down. And so when do you get out? When do you get in? So there's 2 different decisions to make. And if you've got those emotions lurking at you, then especially again, if you're getting closer to retirement, you can't afford to fall back, then you're going to make probably some bad decisions. Okay. And so that's number 3. And that's something, again, even my money, I don't manage my own money. I have somebody else do it for me, because I don't want that, that fear and greed emotions feeding into it. I want it pure science. I want it pure algorithms and computer software making those decisions, which is why we've really done well since we've begun using that method. Well, we've been doing that method for 10 years now. So. The next one I want to talk about briefly is infrequent reviews. In other words, how often do you meet with your advisor or your broker? Hopefully you've graduated to a retirement consultant by this time if you're 50 or older. But how often are you meeting? And not just necessarily, sit down face to face, once or twice a year, but, giving them a call, or them giving you a call and saying, is everything all right? Or me calling up a year or 2 ago, most of my clients, and saying, I want to make some adjustments because of this is happening or that's happening or whatever. A lot of the adjustments we make, we have the permission of our clients to make them without calling them. But if it's a different kind of adjustment, I'll give you an example. We moved between 10 and 20% of most of our clients' assets to gold and silver a few years ago. So they're up about 30-something% in their gold and silver. Okay, so we're constantly trying to stay in contact with that. We're constantly teaching classes that our clients are invited to hear the latest information, the latest decisions and things going on in the markets, and new tax laws and new Social Security laws and things like that. So, I hate it when I talk to somebody and they say, well, my broker calls twice a year and suggests 3 or 4 moves. Okay. Well, when I meet with a client, it's about an hour and a half or 2 hour meeting, because it's not just about the investing part. It's about, what do we need to be doing about this new tax law change? What do we need to adjust about when we're going to take Social Security based on these new things that have come on board? What about, the act that was passed back for COVID that allows us to skip the RMDs? What about your estate planning? Let's review your trust or your will again. I know it's 5 years old. We need to look at it again, make sure it's still up to date. We've had some changes in the laws, I know, here in the state of Georgia when it comes to powers of attorney. So if your power of attorney is over, I think it's over 2 years old, you've got the old one, and it's gonna begin dying a slow death. Okay, so that's the kind of thing. It's not just, hey, how are my investments doing, but what all this other stuff, updating the income summary. All of this that has to do with working with a retirement consultant as opposed to an investment advisor or a broker or somebody like that. So, make sure that's probably the fifth one. Who should you be working with? Well, I tell this story a lot. Back when I turned 50, I went to my doctor, who was my family doctor, right? And I told him, I said I was going to be changing doctors. And he's like, why? We've known each other, I taught you in Sunday school and all this kind of stuff. And I'm like, well, it's like this. I'm turning 50 and I need to go find an expert in people that are 50 and older, an internal specialist, okay? He was just a general practitioner. Nothing wrong with a general practitioner, but I know that as we age, that there are things going on, certain tests. I won't mention some of those, right? But certain things that need to be done that a general practitioner typically would not do. I want them to understand the aging. I want them and that's the same thing when it comes to your money. When you're 35 years old, it's kind of easy. You put money in your 401k and leave it alone. You put in at least enough to get the match. Maybe you buy some term insurance if you got kids or a wife that you might leave behind. Maybe you buy some disability. That's most of the decisions you make. When you get into your 50s and you're getting closer to retirement, there's a whole lot more to it, right? And so that's when you kind of take that next step up and graduate to somebody like us that's not only a retirement consultant, we're also holistic. We're covering all parts of money and retirement. And number 3, we're fiduciaries. In other words, our only license that we hold is the one that requires us to do what's best for our clients. So, if this sounds like something that, hey, I need to talk to Mark, I need to find out more about what's going on with my situation, I got some questions, contact us. Like I said, we have 5 openings this week. If we can't get you in this coming week, we'll get you in the next week. But right now I've got 5. And one more time, just to review how to contact us, the old-fashioned phone, 770-980-9262, 770-980-9262. Website's a great place to go because you can not only schedule right on the first page, but also see more about us. That's masterplanretire.com. We're in Marietta, Georgia, or just Google Master Plan Retirement Consultants, and it'll pop right up. But masterplanretire.com. And then the third way is kind of a cool little way. If you've got I shouldn't say if you have a cell phone, you take your cell phone and you go to the text part, right? And you text the number 21,000 and the phrase is master plan. Okay, so just type in like you were typing in a phone number, but type in 21,000, 21000, and the phrase in the box below, the message you put in there is just the word master plan, one word. And within about 10 seconds, our contact information will pop up. Okay, so also you can find these shows on podcast, all the major podcast apps. You can also find our shows with me live on video on YouTube. So just search Master Plan Retirement on YouTube, and you'll come up with the shows there as well if you kind of want to see me as I talk. I'm not sure who would want to do that, but you're certainly welcome to do that as well. So hopefully now you've got what you need from a standpoint of how to get a hold of us. A complimentary 30 to 45 minute time for us to sit down either on the web or face-to-face and answer your questions, listen to your concerns, some of your dreams and goals, and see what guidance we can help you with. That's all complimentary, along with several reports we can run for you and a copy of my book. So hope to hear from you. Thanks for joining us today. This has been Retirement Roadmap Radio. We'll be here again next week, same place, same time, same bat channel, right? And again, you can find us on podcasts for past shows. We have over 150 shows out there. I'm not sure if they're all on podcast. You can also find a link on our website to the radio show and the podcast as well, masterplanretire.com. So until next week, Hope you'll join us next week. Tell your friends about the show. And finally, remember, plan well and prosper. Have a good week, everybody.